Hello and welcome to the Take Charge podcast. I'm joined today by Robert Neivert, who is the CEO of Ionobell. Rob has also spent 10 years in VC, with plenty of exciting ventures to his name. He's an engineer turned entrepreneur, and his unique pathway to establishing Ionobell isn't one to be missed. Rob brings so much energy to this podcast, using his VC experience to provide exceptional insight and advice to those looking to raise investment whilst maintaining and optimizing existing investor relations. He essentially provides a step-by-step process. We review 2023 and project how 2024 will look from an investment perspective. So thank you, Rob, for taking charge and bringing so much value and insight for our listeners. Hi, Rob. Welcome to the show. Thanks for coming on.
Yeah, great. Thank you.
Yeah, really glad to have you on today. We're going to be talking about Ionobell and your background in VCs and investment. Obviously, a nice combination. So I think you're going to be able to talk to quite a lot of things that our listeners will take a lot from. So yeah, let's start with your history first of all. Talk us through you and your background.
Yeah. So I'm one of the old timers here in Silicon Valley. So I actually have an education. I have 2 engineering degrees, a degree in economics, mathematics, and an MBA. Turns out I'm a terrible engineer, but I'm pretty good on the finance and business side. So I've been at this a while. I've been through 9 companies. 4 of those got acquired along the way. I've been a VC for about 10 years, and I've been an entrepreneur for about 20 or 25, depending upon how you count it. So I have a little bit of experience on both sides, and I thought maybe I'd bring to this show a little bit of understanding perspective of flip-flopping back and forth and see how I can help people maybe raise funds, do a little better job of working with VCs to help you understand their point of view, but also from the understanding that, sometimes it's impractical what VCs ask for. So to understand how you can manage that as well.
And this is obviously subjective, but from your perspective, do you enjoy life more as a CEO now or in the past or as a VC?
So it's a really hard question because they're so different. Like VCs are about networking and being it and getting out information, but it's also a lot more comfortable lifestyle. I mean, the amount of you're based on a portfolio. So oftentimes you're betting on 20 or 30 bets and not one bet. Like as an entrepreneur, you're on one bet. You're one thing. Either you win big or you die, right? But for a VC, you're managing a portfolio. So you're really trying to basically just play your winners and then skip out your losers. So if I'm a VC and I have 20 companies and I have a couple of 5 companies that aren't doing well, I'll just ignore them, right? I'm not going to put anything into that. I'm just going to focus on my top players because for a VC, almost all of my return is the top 3 to maybe top 10%, but most likely the top 3% of my portfolio is going to be where all my money is. So I'm going to put all my effort there. So it's a really different perspective. It's a lot easier and more straightforward to be a VC. You can manage your time and manage better because, and I use this funny expression, people answer your calls. Like if I send out emails as a VC, I get a high response rate. Most people respond back. I get invited to panels. It's a lot easier to be a VC if you have a fund. As an entrepreneur, everyone ignores you, right? Unless you're famous or have been a big exit, everyone ignores you. So you have to fight for every inch as an entrepreneur. But you kind of coast along a lot as a VC. And I know VCs, they don't see it that way, but certainly playing both sides, I'm going to tell you, entrepreneurs are much harder. It's a much more brutal thing. But if you like to build stuff, if you have this real sense where you want to build something and do something, it's no comparison. The entrepreneur is going to win. And so me, I like to build stuff. My wife, she would really rather I be a VC.
Yeah. Does your interest change though? Because I guess you've kind of flip-flopped in between the two. Maybe priorities
Definitely.
change after a few years. So
yeah,
I guess
every time a company fails, I decide I'm going to be a VC. Every time I'm a VC for about a year or 2, I decide I'm going to be an entrepreneur. Yeah, you do. And also that changes what your priorities are in life too. If you have kids and you want a more stable income, it's totally different than when if you're young and you're like, well, I can live on ramen and live in a 1-bedroom apartment for a few years. That's okay. So you need to match it to what you're looking for in life. And I'll also say most people don't have much of a choice though. Like I'm presenting this like it's a choice, but the reality is VC is a career path that people start all the way back in college, taking the right courses, getting the right internship, getting that finance background. They almost all come from the top universities or from a handful of business schools. And that's a vast majority. It's sort of, I used to refer to it as the McKinsey train. It's like the top couple consultants, a big exit, or a major MBA school. Other than that, there's very few VCs outside that. Now, there are now some diversity and some stuff going on, but a vast majority of them are from that. So in many ways, unless you're on that track and decide to step off it, it's really hard to step into the VC track. It's not impossible, but it's certainly hard. So I don't really see it as a choice for most people now. Interesting enough, I'm sorry, I'm old. So 20 years ago, it really was quite a bit different. Today, it's a track. I mean, there are hundreds of people competing for those VC jobs. So it's very different.
And what was your
I do point out, I apologize. Yeah, I'm going to apologize. There is one exception to that. If you are an entrepreneur and you are successful, especially if your exit is more than 250 million, both paths are completely available to you. That's like I'm going to use the golden ticket, as it were. But that's a pretty small number. And when we talk about that later in this discussion, we'll talk about the fact that that really is a small number. People read TechCrunch, they read these news, like, oh, everybody's succeeding. Why am I not succeeding? But that's a tiny, tiny percentage. I mean, VCs only fund 1% of companies that they interview. I mean, just imagine what the percentage chances are of being one of those major exits. It's very small. So you have to be careful. If you bet all your hopes, if you go to bed every night thinking, I'm going to be that 1%, 99% of those people are gonna waste their lives. So don't. I mean, understand that it is there. I'm not saying don't hope for it, but you gotta live your life along the way.
Yeah, no, definitely. And yeah, how did you start out into VC?
How did I start in VC?
Yeah.
Wow. So I think the easiest way to understand how I started was that I had a company that was getting funded by a bunch of venture funds and a bunch of others. And at some point I realized it was not going to make it. And I had to have that really hard conversation with the investors and everyone else saying, this isn't going to make it. Like, we could make this, but it would be something called a zombie, which means we continue to exist, but there really wasn't going to be a return either for the employees or for the investors. So we made that decision to shut it down. And that was a very painful one. But at that point, I had built relationships with many of my investors. So a lot of them were like, hey, come work for us. We see your skill. You see your capability. And that's how I ended up coming in. I don't know as many people will have that path today because of that huge amount of visibility where a lot more of these MBAs and consultants are coming in. It's actually much harder to get into that path than it used to be. But back when I was a little younger, that was a very viable statement. They hired in a bunch of the entrepreneurs, even if they didn't have a big exit. Today, I don't know any major partners that kind of came through the failed path. I'm uniquely a high failure. I don't know how to categorize that. So there you go.
A high failure. There you go.
Yeah.
And let's talk about Ionobell. So what inspired you to found the company?
So I originally, this is the running joke, I originally rejected the company. That was the funny part. They came to me for an investment and I rejected it. And I said, here's the problem with this company is, and I won't go into too much detail, but it was way too capital intensive. And I said, here are 100 competitors. I said, you're going to be competing against major battery companies like LG and Samsung. They'll crush you. You need enormous capital in order to compete. And it is an incredibly rare condition to be able to raise that kind of capital. And so when they approached me, I actually rejected them. And what I said to them was, you need a different business model here. And at the time when I rejected it, I was approached by a very talented, I need to avoid exactly her title, but she's a very senior person, very senior technologist at a very influential electronics company, and an expert in the field. And she came back and said, it's really, really good technology. They just have the wrong business idea. So if you fix the business, this could be amazing technology. So when I got involved and I said to the team, you need to prove that it's viable. And because I'm a VC, I set certain goals. And I said, you have to prove that customers want this, that there's product market fit, that you can hit this. So what I did was I arranged meetings for the team to meet with the end clients, in this case, automotive companies and electronics companies. And I made them sit through the meetings with these guys as they detailed what they needed from the product. And the engineering team came out and said, wow, that's totally different than what we were trying to build. And that's the foundation of it. You don't build technology. Nobody cares about technology. VCs don't invest in technology. They invest in solutions. So I tasked the team and I raised them a bit of money, about $500,000. I said, prove to me you can solve the problem. I don't care about the tech. I care that you can solve the problem. And that actually became the foundation of where Ionobell came from. Was after a short period of time, one of the automotive companies tried to buy us. Like, that was sort of the proof that we were solving a problem. And I'm like, okay, that's proof we're solving a problem here. And that's foundationally why Ionobell is very different than most companies. We're not really trying to do everything. We're not trying to build great technology. We're trying to solve a foundational problem with batteries, that they're really expensive and that they really aren't very energy dense.
Amazing. Yeah, as you rightly say, VCs don't invest in technology at solutions. What is it actually going to bring? What is it going to solve? It could be really, really cool tech, and
Yeah,
it might even be something, that person's bias and something that's kind of like a bit lifestyle-y. But,
yeah.
they want to see the solution. They want it to
Solution,
be the real
yeah.
world.
I mean,
Yeah.
I joke. You think Facebook was the first social media? No, right? You think it was great technology? No. You think Uber is great technology? Boy, I pull up that app and I'm so impressed by it. No, I mean now it's a fairly complicated app, but back then it wasn't. But it solved the problem. You needed to get around. You need to get the taxi. That's the solution. Technology people, they focus on the technology. They try to solve hard problems because that's academia. That's not how things work for VCs. If you have a simple way to solve a really hard problem and you can defend it, VCs are fine with that. They love simple solutions. That's easier. So understanding what they're looking for is solutions to complex problems of which you can defend and of which people are willing to pay for. Doesn't matter whether it's big or small or hard or not. And foundationally, that's hard because the very people who solve these problems, they don't think that way. They think in terms of the technology. And the people who are looking for those solutions, they don't know how to use tech to solve it. So that's the very foundation of how startups succeed, is that they connect those two ideas in the founding team.
Nice. So you obviously came in and changed things. So talk us through the current, the current status, your value proposition, technology. What's the focus for you?
Yeah, so foundationally what I changed was we're not building technology, we're building solutions. We're always starting with the customer and their specifications. Everything from the equipment they use to the supply chains they want to use. After every one of those meetings, everybody said, the engineering teams or the development teams always come out and say it's impossible. And you have to get used to that. I'm like, yeah, it's always impossible until somebody solves it. So I said, but if you solve it, now you have a company and now you can fundraise. And functionally, you work with VCs the same way. You demonstrate as you come across hurdles or solve things. So my statement was I changed how they built products. I changed how they think about products. I changed, instead of us building our own batteries, which was the original idea, we now collaborate with a supply chain to build batteries to avoid all that infrastructure cost that we wouldn't have to cover. Focus on what we're really good at, which was the IP and the technology, and allow other people to take margin in order to allow us to go to market. So foundationally, I changed that. I changed the team a bit in that I hired people specifically just to build the technology, and I handled all the rest of that. And that allowed the team to focus, right? But you have to maintain the management. They have to only build things that the customer wants, not cool technology. And so I'm changing a little bit of the teams, the team members, change how they function, how things work, the guidance, how things run. And that helps really if you think about it. My job is to point them where to shoot. They're great shooters. They're going to take that arrow. They're going to hit that target every time. I have to tell them what target to shoot at. That's my part. And so I think honestly, I'm not shooting the arrow. They're doing all the hard work. All I'm doing is telling them where to shoot. But that's important. I don't consider myself the most valuable member of the team, but if I'm wrong, doesn't matter how good they are. If I'm wrong, it's dead.
Absolutely. So the first idea was to make the batteries, manufacture the batteries, obviously kind of change that a little bit. What is your kind of, how do you collaborate with other?
How do we collaborate today? So today we are licensing. So we license the IP. So we designed a series of ways to make very low cost silicon that is very low swell and that can work in solid state and various kinds of batteries. And there are 100 companies that do that. We figured out a way to do it very cheaply. We figured out a way to use existing silicon production partners to produce it, which means we can get to the thousands of tons a year, which is what an automotive company wants, within a very short period of time, like a year or two, because we don't have to build facilities. They exist already. All we do is license to them an ability to build a slightly better version of it. So by focusing on just the piece we do, much more rapid scaling, much less capital is required. So we are just a licensing firm. We just licensed to battery producers and silicon producers and everyone else, anode producers, a series of technologies that allow them to build silicon anodes very cheaply, inexpensively, and easily.
Very good. And I know how hard you work, Rob.
Yeah.
You've told me a few times, like,
Mm-hmm.
in terms of your hours and relentlessly working over the holidays, which I'm sure your wife loves you
Mm-hmm.
regardless for.
Oh no, she
Um,
appreciates it. I get to leave her alone, so she goes to
yeah,
do her own
go back to
thing.
work. Yeah, go back to
Mm-hmm.
work. um, so the future hopefully is very bright for you. But what do you envisage? How does the future look for Ionobell?
So I envision Ionobell being like ARM, which is basically a licensing house. And so I hope, or I envision us to basically go out and license various technologies to everyone from battery companies to silicon companies. And as we continue to grow, we're going to continue to build this portfolio. This could be anything. We could be licensing all kinds of technologies and batteries and maybe in the future, everything for electronics, agriculture. But it's all going to be related to a basic foundational thing that we develop new materials and then license the capability of them production. Today, that's going to be silicon probably for the foreseeable future, and it's related technologies. But in the future, I don't know. As the company gets much larger, we'll look for other opportunities. But today, just licensing in the battery space, it's billions and billions of dollars. And one of the key ideas that I get people to understand about this is, and the announcement this morning from Apple is a great example. Apple Watch today got pulled off the market because they violated one patent from one company. When you build a product, you have to have every single patent for that product. It's really, really hard. But if you're the patent guy, they only have to step on one of your patents for you to have to be able to negotiate fees. I hate to be called a troll on that, but it's kind of troll in some ways. But I'm not trying to make things difficult. I want people, but I don't have to have every patent. I just have to have something that someone wants for me to get income off that. And what I'm hoping to do, and this is sneaky, if you really want to influence climate change, if you really want to make a difference, you cannot raise enough money to do it by yourself. But if we develop a huge amount of technology that enables hundreds of other companies to do it, we can make a much vaster, better improvement in climate change and move it much faster. Imagine, and this is completely impractical, but imagine if every battery company today could access all these technologies that save them time and money and resources and could recycle. Yeah, okay, totally blows up capitalism, but think about how fast that moves in climate change. So if we become a huge IP house and we're readily, actively licensing at a fairly reasonable cost to all these players, we can allow things to move much faster. So it's a sneaky way to drive climate change by stop being such a hoarding capitalist.
It's a really good point. And in a previous conversation, we're talking about collaboration being the key to solving climate change because, always talking about the race between, North America and China. Maybe it's not a race because, we're not going to be able to catch up with.
What if
that
they
rate
move
of-
together, right? What if
Yeah.
everybody moved together? What if they shared technology and advances? What if, now it's completely impractical as far as capitalism goes. So I'm not trying to wreck the world. I want you just to imagine the idea as to why people like me realize, hey, if I build a huge portfolio and I'm willing to license it, I don't have to charge a lot of money. Because everybody's licensing it. Very broad. I can charge very low amounts, which enables a huge number of players. Even things like Samsung and LG competitors can both license it and both be successful. So if I want climate change, if I want an improvement, that's the way to drive it way faster. There is no way for me to raise enough money that I could somehow do that any faster than if I simply license it to all the existing players. But it's harder. You have to build technology that people can implement. So that means you have to put more constraints on your engineers. That drives my engineers crazy because they cannot use technology that doesn't exist in production already. They can't create a new piece of equipment because nobody will buy it. That makes their job much harder. But if you win and you license broadly, climate wins. Everybody wins. The whole price of EVs drops. All of these advantages. But boy, is it a big risk. I don't know if this is a risk for every company should take because it's a huge, huge risk, right, that I'm playing. But if I win this gamble, it's like the lottery. It's monster payouts for the environment and for my team and the investors too.
It's a common theme. I think everyone's been there at some point where you hoard your ideas, your IP and things. I think when you tend to get a bit more experience and get a bit more perspective, it's like, okay, share those ideas, share that IP.
I can make more money.
Yep.
I will make more money licensing than I ever would by building it. And that is not for everyone. That's not a true statement for everybody that's listening to this, but it is a true statement for me and my team. We are designed for this.
Yeah. And rather than trying to
Mm-hmm.
build your own gigafactory, you would make
Yeah,
more of a positive impact on the environment and the industry as a whole in terms
yeah,
of overall advancements by focusing on one niche area, which will then
exactly.
fast forward the whole
What
industry.
happens if I get Northvolt to build a battery with even 10 or 20% cost advantage? I'm driving the cost of EVs down. I'm driving adoption of EVs up. I'm doing all these. There's no way I could raise the amount of money Northvolt raised.
Yeah.
But if I license some technology, I get the effect. So if you are both an impact, if you want both impact and money and financial success, this is a much better path. But if you're young, you say I want to control this. I'm not sharing it. I'm not okay. But that's your goals are going to be different. They're financial, probably not climate. There's almost no way to raise enough money.
Yeah. Well, let's move on to
Mm-hmm.
onto investment and some
Yeah.
tips and things like that. But good luck with Ionobell, and hopefully that future
Mm-hmm. Of
is
course.
is is, is bright for you guys. Um, is it true you mentioned? I think you only have a 1% chance of
Yep.
raising investment.
Yeah, let's flip and look at a VC's point of view. On a VC average, they're going to invest in about 1% of the things that they look at, that they actually evaluate, which is it's even a lower number than that if you're considering things like cold emails. So if a lot of investors are only doing a handful of investments a year, so you have to understand that if you're going to raise an investment and you talk to 20 investors, there's a very high probability the number is going to come down to zero. So if you want to target and want to raise a round, and there are two types, well, I'm going to simplify this a little bit. There are generally two categories of round. One's called piggy rounds, one's called party rounds. Party round means there's multiple VCs involved. A piggy round means one VC decides they're going to take the whole round. Piggy rounds are pretty unusual this year. They were a little more common a few years back, but therefore you're going to need 2 or 3 investors. And if they only have a 1% chance, how is that going to work if you only talk to 20 or 30 VCs? So what we do is we talk a lot when I do a lot of training classes with the startups. So at 500 Global, which is the VC firm I work at, I run a series of training classes for startups, and we just walk them through the process and the math. I'm going to do it in 3 minutes. Unfortunately, it's a multi-hour process, but at the high level, you're going to build long before you go out to raise money. You need to start building relationships. Look, if you only call your mother when you want money, it's a very transactional thing. You're not getting much. Think about building relationships ahead. Build reputation ahead of time. It's a lot easier for a VC to invest in something called lines and not dots, which means they want to see several points from you. Oh, you made progress. Oh, you signed this. This line, this progress, makes it a lot easier for them to invest. So the first thing is, if you're going to raise a round, long before you raise the round, start by building everything from reputation to relationships ahead of time. Long before you start the round, you're then going to build a target list. And a standard target list is 1 to 200 VCs, of which invest, that means they have a thesis match. They invest in your area. They write a check of the size you're looking for. They invest in the round that size that you're looking for. And they invest in the geography that you're in. And that eliminates a huge number. You have to understand that that comes down to a fairly specific list. So you're going to build this list until you get to 100 or 200 of this. These are a list of VCs. Then you're going to figure out which partner is most likely to work with. Single people make the decision, not firms. So you're going to figure out who you want to talk to. Try to build a relationship, try to connect with them, try to see if you can get some reputation with them. So you're going to target this 1 to 200 list. You're going to target these names of these partners. You're going to figure out, if you don't know them, how to get an introduction to them, because cold emails have almost a 0% chance. They're not zero, but they're very close to zero, except that maybe at seed level, it's almost zero at the A and the B levels. So you need to build a relationship. You need to get a warm introduction. So you need to line all this up long before you go out to fundraise. And at the point where you start needing to fundraise, you need to actually build your document set, like your presentations and your support documents. Again, before you really start the process, you should have a lot of those pretty much built out. Because once you start the process, you're not going to have time, and it'll force you to think about your story, which is really important. I can't tell you how many entrepreneurs get on the phone with me and they haven't thought through their story. So they just tell me about their product. And I'm like, okay, product is like 10% of my decision here. So tell me how your go-to-market plan. Oh, we're going to sell to this big company. That's it. That's the whole plan. Yes. Okay. So by preparing your documents ahead, it's going to force you to think through your go-to-market plan, your technology plan, your fundraising plans, all these sorts of things. And there are some online documents to do that. So now you've prepared your documents. You've prepared 100, 200 VCs on a list. You've got your partner names. You've got a list of people to do those introductions. Now you're going to run a test. For those who know how growth hacking works, this is a growth hack, basically. Do not email and try to set up meetings for your best investors in the first round, because you're going to have some mistakes. Send it out to people you know who will give you feedback or are more friendly or are not as important investors, and test run it for a week or two. Get their feedback. Most likely you will learn something in the first few weeks. Your pitch is off. You forgot about major competitors. Your deck doesn't come up. They won't enter the password. You thought you try to make them enter a password to view a deck, which, by the way, almost no VC does. So you've learned these things in the first few weeks, especially if you haven't raised before. Only at that point do you actually begin your fundraising effort. Now what you want to do is what's called bursting, which means you're going to send out a fairly large number of emails and try to set up a large number of meetings in a high density. 2 to 3 meetings a day is sort of the target. Have a little bit of time in between to get a rest and get some food so you maintain your energy. But you need a high density because, as I mentioned earlier, most rounds are multiple VCs. They all have to get to that same point at the same time. So if you get one investor but no others, you have to just draw out the process, and then the first one moves on. So you want to move them all together. And that's why you also have to have documents ready. So you're going to try to set up all these meetings. Then you have to prepare for the meetings. You have to have the decks and the follow-up and your data rooms. Again, I'm not going to go through all the detail. You can read up a bunch of that online and what needs to go in those. But those all need to be set up. And then you move them through this process. And back to your 1% statement, a standard company that has a fairly reasonable growth rate will do between 100 to 150 in a good year. In a year where VCs are active and percentages are pretty good. This past year, unless you were AI, that number would have to be close to 200. It's much, the funding numbers are less than half of what they used to be in terms of percentage chances. Again, it varies from, we can talk about the difference between seed and A, but just crudely speaking, that's about the number. So because you're targeting the sort of 1 to 3% funding rates. And as you go through rounds, just because you get your seed round, only 60% of people won't get an A. So only 30% are going to the next round. And of the ones who get an A, only about 30 or 40 get a B. So you have this huge series of fall-offs that happen. You've got to be the top percentages again and again. And that's rough.
Interesting. I like the idea of kind of trialing it for the first 2-3 weeks on people kind of getting really well versed with it and kind of working out the mistakes, and then kind of hitting the big, your kind of ideal investors with, when you're kind of all
I've
practiced.
done 9 companies. And even in this company, when I did it the first 2 weeks, I was wrong on at least half a dozen points. And I've done this a lot. If this is your first company, you're going to be wrong a lot. You're going to present it wrong. People are going to like it. People are going to think the math is wrong. Be okay with it being wrong. Just fix it.
Yeah. And you mentioned it all, which I agree with. Cold emails just don't work.
Nope.
And you mentioned kind of building the relationship and is important. What's the first step to kind of getting in the door and kind of building that relationship?
So everybody has a different superpower. Everybody has a different thing. Some people are really good networkers. Some people are really good bloggers. Some people are really good at doing panels. You have to find how you do it. So I can't tell you how to do it, but I can say that think about how you might. There are many ways to do it, whether you're panel or building reputation or speaking or doing podcasts or all these things, or getting warm introductions. If you have reputation, getting famous or well-known people to do the introduction, to do intros that way. But always think that path long before you need to fundraise of how you're going to get there. But I wish I could tell you there was one, but there isn't. It depends on what you're good at. So I am super lousy at what we call large event. Like if I go to a big battery show and I'm just like, bleh. I have no energy for meeting random people and having random conversations. That's just not. I work really well by building reputation with people, helping them out, building relationships, not only with VCs, but with hundreds of players in the industry. So like just this weekend, I wanted to connect with a VC. I looked at the connection. I see they're well connected with 88 of my friends. I have 88 people connected with them. So I go through the list, figure out which one owes me a favor, which one I've done something for. I say, hey, what you do? And this is important. Don't just forward the email. I want you to make a recommendation. I want you to actually say, hey, this guy's really good. You should talk to him. This is important. If that person has reputation with that VC, they'll almost always take that first meeting. And since more than 90% of the time you don't even get the first meeting, I just jumped 90% ahead. Make sense? And there's a big difference between someone forwarding the email, like oh, here's somebody you should talk to, and being a reference saying, hey, this is somebody really good you should talk to. And it's important that you build enough of a relationship with people, or you're asking people that can actively say, because if a VC just gets it from someone, even if they trust them, if it's just a forward, it's not worth much. What you want for a VC is the VC receive a message from someone they've made money from, somebody who's done an exit or they've done deals with, and to carry words, I recommend, or this person's very good. That's what the VC wants to see. Because like me, I get 10 to 20 cold emails a day. 100, 200 a week. That's just the cold. That's not even the warms. It's just the cold ones. I don't have time to read those. But if I get one from someone I know is good and they say this person is good, that's a huge savings for me. That's a huge de-risker that I'm not going to waste an hour with this. So look for building enough reputation where people know you're good. It doesn't have to be the VC. It could be someone who can reference you to the VCs. Does that make sense? Obviously, it's best to talk to VCs. And also remember, VCs want something from you too. You have value. You have knowledge and information. And maybe unfortunate or not, I get a lot of calls from VCs, people are associated with mine, say, hey, we really don't understand the battery industry. Would you walk us through why sodium doesn't work or why it does work? And I provide a certain amount of help to them. And I say, here's the analysis, here's the charts, here's to be helpful. And I build reputation with them as being an expert. So when I do come to them later and I say, I'm looking for a round, I've built reputation with them. Now, it's hard to be that person unless you're a professor or have that. But as I say, everybody has a superpower. If your superpower is really being good, share that information, share your position, do positionings such that people come to you for that. And that can be your way of getting to the VC. If you're really good at getting on a main stage at an event, do that. If you're really good at writing blogs, try to write blogs and get them posted. Find your superpower.
Great advice. And then in terms of timescales, obviously for everyone it will differ depending on their runway and, you know, but how long would you recommend or how soon would you recommend starting, obviously, that process of identifying the list of between 100 and 200, having those initial kind of outreach and meetings through to closing?
So going to vary a lot. So I'll do an example. You'd start, like, you're going to constantly be building that list for VCs, right? You don't want to have to burst that. So basically almost every week you do a little bit, I found this VC, and you add it to your list and you sort of do that work. So that's an ongoing. Previous to 2023, previous to this year, because I want to exclude this year because it was quite different, most people expected 6 or 7 months to do sort of a seed A of reasonable equity round, seed to A, assuming you were within what they call the primary parameters, which means you had a certain amount of growth and a few other things. Previous to 2023, that number is 9, 12. I've seen 14 and 16 months now. It's crazy numbers. And except if you're in AI or one of the hot spaces, that 2023 numbers got ridiculously large. And there's a bunch of reasons for that. I'm not going to go into it. VCs themselves are having to mark down. There's a bunch of issues with their funds. A lot of them haven't been able to fundraise either. There's a bunch of reasons here, but I don't want to bore this group with that, simply to say that it's a lot larger. 2024 is looking better. The drop in the interest rate on the US side and a few other things should free up some capital. We are hoping, we meaning the industry in general, some IPOs and acquisitions to start up again in Q1, which should free up capital again and bring those months down. But today, ongoing process for collecting the interesting, you should start the bursting, which means that first trial at least 9 months before you run out, at least 9 months. You should have a contingency plan or talk to your existing investors to have 3 months of sort of emergency capital available to make that 12. If you have no emergency capital, have no backup, then you need to start 12 months ahead. Now, 3 months from now, I might completely change that advice. But today, that's what my numbers look like. And I'll also reference some really useful sources here for people. Carta publishes lots of stuff on their LinkedIn feed about sizes of rounds and how long they're taking and the terms and stuff like that. Super useful. Law firms, Wilson Sonsini and others, Cooley Go posts a bunch of information about rounds, round sizes, how long they're taking, a bunch of stuff like that. Super useful. Signal, NFX Signal, super useful for finding out who the VCs are, what they fund, what their checks look like, all that sort of stuff. Super useful tools here for helping you with this process. There are Crunchbase and PitchBook, but they've just gotten really expensive. Unless you have a lot of money, it's really hard to afford those tools. They've sort of priced themselves out from entrepreneurs for the most part. You can sneak it like I work for a VC firm, so I can, hey, would you run this report for me? But they're pretty pricey. But if you can access a university, other ones who have access to those, super useful, but just pricey, hard to work with. Middle East and a few other areas have a couple of their own specialty tools that will help with this.
Great. Are you happy for us to list those resources in a link,
Yeah,
perhaps?
yeah. And we
Yeah.
certainly can chat about that, and you can post them up. But mostly, you can just do a search on those terms.
Yeah.
Crunchbase, PitchBook, Signal is NFX. You'll see it. Just Signal VCs, whatever, and it'll come up there. A bunch of all super useful. LinkedIn is a constant. I am on LinkedIn every day, trying to share messages, trying to do likes, trying to build relationships, trying to be helpful, sending information. When I see someone post an article, I say, here's another interesting article you might find on that. If a VC posts their thesis about something and you can be helpful, you send them a thing saying, hey, here's this article or blog that you might find helpful. You're establishing yourself. So LinkedIn is a constant source of that for providing to these people so you can build that relationship ahead of time. It's unfortunately 1,000 shots in the dark to build those handful of good relationships.
Yeah. Do any of these percentages change or timescales change? So, your likelihood of securing investment and the time in which you need to start, depending on whether it's Series A, B, C, D.
Yeah. For the most part, most of my things are for seed and A. By the time you get to B, it's the bigger changes at that point. Normally, you have enough of a team, professional. You start to build the relationships. By this point, there's a lot larger relationships that exist already. If you're going to B and you have no relationships, that's I don't know how you're going to do that. That's odd. By then, usually you've talked to lots of investors. A lot of those investors are actively in discussion with you. The numbers are much smaller. The number of trials, like there aren't 200 C and D round investors for your particular topic. Like that's pretty rare to have that number. So the percentages, those numbers come down, but the relationships take years. If you're looking for a $50 million check, which is some of the late rounds, if they haven't spoken to you for a year, meaning they've actually literally been talking to you for a year and they're getting your financials for a year, then they're ready to do that round. But you can't just cold call. If you cold email someone for a $50 million check, I actually have no idea what that number would look like because I've just never heard of anybody doing that successfully. I'm sure it exists. And I heard a rumor that there were some crypto companies that worked that way. They just spammed like freaking everyone and they actually signed some big checks. But I'm not familiar with any of that working at any reasonable level. So the later stages are relationship, long-term. There are a lot more things about financials, spreadsheets. There are a lot more about the numbers. Early rounds it's really hard because of the way things work on the A round. These guys don't have full-time analysts to make one investment. When you're investing $100 million, you can spend 1,000 hours on the investment and still be viable economically. If you're doing a $100,000 check, you can't spend that kind of time. So it's different math.
Yeah. So you've touched on a lot there, but when raising investment, what are your 3 top tips for CEOs and entrepreneurs?
We covered a little bit, but sort of start a long time ahead, build this reputation. If you're only calling them for money, it's actually hard to do the round because they want to see progress. They want to see milestones. They want to see progress. So preparation and upfront is very important. The second one is every VC has a thesis or a milestone at which they're looking for. They're usually metrics. For example, a lot of VCs in the consumer space are saying, well, the big thing I care about is LTV to CAC ratio or month-to-month growth rate. If you don't know what those numbers are long before you get to fundraising, you're really in trouble. If they randomly hit you with a metric that you haven't known or tracked, the chances are you're not going to have a good result on it. So one of the reasons you build these relationships months ahead is you get a feel for what the metrics look like for you to raise your round at the valuation you want. So if you want to raise an A round, it's a 1.5 million ARR at a 90% margin with an LTV CAC ratio of 6 or better. Like that's a generic sort of metric. You need to know that months in advance so that you make sure your numbers look appropriate for the EECs, because ultimately that's how they're measuring you. If you don't know how they're measuring you and you call them up and try to sell them or try to get them into a round, chances are your metrics are not going to match. So be prepared, know what they're looking for ahead of time, and make sure you're measuring and have those as part of the preparation. The second one is, and I'm gonna use a couple of things which are very unpopular for me to say, but I'm gonna say them nonetheless. This getting in there and thinking you can totally like make stuff up and make up your metrics. This does work, and there are successful companies that have it. This whole fake it till you make it. The VCs, especially in this year, have gotten a lot more discerning. If they find a major issue or flaw, which means they think you're really full of it or making something up, the whole relationship is dead. If they cannot trust you, they can't accept any information. Early investing, there's no auditors. There's not a lot of outside audit or anything like that. So they're really having to trust you. And if you break that trust early, you're dead. Every other number doesn't matter if they don't believe you. So especially early, you're building a relationship, you're building trust. You certainly can market, you certainly can position, but be very careful about hurling bull. At some point, if the trust is gone, you're dead. And it gets ugly. Everybody points to a handful of companies, whether it's FTX or a whole bunch of other of these financial companies that have managed to fake millions of users. Yeah, there are a few. And honestly, I even have friends of mine who managed to fake it. It does happen, but it's not really the right number to play. Be optimistic, be hopeful, forecast, but don't just make stuff up. It really does get quite problematic. So be prepared, know how to position so that you can be optimistic. And the last one is have a unique value proposition, meaning I get pitched. I cannot tell you how many people, like in the last week, I got at least 10 pitches that all are the same thing. So imagine you're a VC. They get thousands a year. They all are pretty much like, even my company. My company does batteries. We do silicon anodes. We do, there's 150 companies pitching the same investors that do almost the same thing. Have a reason why you're different. Stop thinking if you ever say to a VC, we're the only one in this market, we have no competition, just go ahead and hang up the phone and go home. You're done. There is no chance of a round here. You've already shot yourself right in the face. There is, I guarantee you, competitors. You're absolutely not the only one. Please don't do that. It just makes you sound incompetent. Know your place in the market, know your position, and say, this is where people are, this is where I am, and this is why I think this is going to win. And if that matches the thesis of the investor, they'll go with you. And if it doesn't, they're not going to. But that's okay. You got to find the ones that match your thesis. Find your unique value, stand by it, have good evidence it's true, and look for people whose thesis match that. My statement, the one I stand by, is we're not building our battery. It's impossible to compete against battery companies. We're going to license. And that's a foundational element. So it tosses out like 80% of my competitors. And if they disagree with that, they say, no, you're going to have to own the IP and build it. They're not going to invest in me anyway. So we clear it out. They're not going to invest. We move on. That's my part of my unique value. Make sense?
Nice. Very good. 3 very good tips. And the transparency piece might flow into the next one. So my next question was going to be, okay, that was for raising investment. What about when somebody already has investment, maybe they're going through additional rounds? What is your top 3 tips for maintaining relationships and maybe expanding those?
Preemptive action. I'm going to use this term, preemptive action. Don't wait for them to find it's a disaster and then they call you up and you go, like, if something goes wrong, preempt it. Open the conversation before they ask you. If they have to chase you, they don't trust you. So I send out a monthly update to all of my investors. And I'm very straightforward. This went wrong. We screwed this up. And then the line after it, I say, here's how we're going to address that problem. Give them a solution to the problem. Don't just present problems, a list of problems. It's your job to solve them. So be on forward, be straightforward, but present solutions. Just last week, I had an issue where I had an investor drop out of something that was very important, that was very foundational for what we're doing. And I sent out a thing to the update to the investors this weekend saying, this didn't work. Yes, we're in a worse position this week. Here's how I'm going to address it in the next week. Let me know if you can help. Most of them will collaborate with you. Most investors, especially the ones that have been in the field for a while, they know that there is no straight line to success. These are all TechCrunch articles. Please stop reading TechCrunch. It's really disastrous for the entrepreneur. No company does this. They all have these ups and downs. It's always this terrible thing. Even my most successful companies are almost bankrupt at some point in their life. Like the path is hard and it's never straight. TechCrunch wants to make everyone a hero. Those are mostly made up stories. I read them, I'm like, I know this guy. That's totally false. His sister didn't die. That's not where he started the company. What are you talking about? He doesn't even have a sister. I'm like, I've read some of these articles. They're just complete. They're like, oh my goodness, this is totally made up. They're what's called post-fact makeup. After the company's a success, then the founders go back and recreate a founder story. Those really aren't the reality. Things are tough. Things are bumpy. Be straightforward. Work with your investors. But remember, your job is not to give them problems. It's to give them solutions. This went wrong. Here's how we're going to solve it. Can you help? They might come back and offer different solutions. And yes, in the very beginning, a bunch of them will be upset. But they'll realize that they're really getting what's going on. And they can really work on the problem. Don't get to board meetings and surprise people with information. All board meetings are decided long before you ever get to them. Everybody should know what's going to happen in that board meeting. Board meetings are social events. Seriously, it's total waste. You're not making any real decisions there. Everything gets done ahead of time. You do private calls. Everybody knows what's going to happen. You've really worked things out. Yes, you're getting together to get everyone to agree to the decision, but 90% of the work's ahead of time. So preempt board meetings, preempt bad news. Work with your investors ahead of time. Keep them informed. Work with them in a collaborative way. Right? Stay informed. Remember, they're your biggest asset for your next round is going to be those VCs forwarding it to the next round investors saying, this is a good company, they're succeeding, you should talk to them. It's one of the strongest parts of your investors. Once you have investors, they'll invest you to the next round. Especially if they're well-known VCs, it's a huge, huge difference. It's a huge introduction value. The probability of getting an interview, getting that first round discussion is very high if you have good investors in the first round and they're backing you. And by the way, it's a huge negative if they don't. If you reach out to a new investor and you say, I'm raising this round, blah, 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 and they say, I see this round was this, they're going to call them. And if that investor says, he doesn't really share with us, we don't trust him, it's really hard to raise a round. It's crazy. Even at multi-billion-dollar companies, you see boards that say, I won't reference exactly, but say dismiss a very high-level CEO because they don't trust him, and it turns into a complete mess, shall we say, in the last few weeks of public information, those who know what I'm referencing. It's a real messiness. And if they don't trust, they don't feel they're getting communication, that's really risky for them. So communicate, be preemptive, share bad news, but show solutions. Don't be afraid to do that with them. And also the other thing, understand that they're going to drive a lot of your next round. So be aware of that's how this world works. And my last one is spend some time to understand their world. Spend some time to understand how their funds exit, how their LPs see the world. It really helps because, for example, I know when I need to exit for my investors to meet their fund obligations. And if I can help them meet their targets, they are really supportive. And it also helps me understand why when I get on a call, they push me for an acquisition when just a year or two ago, they absolutely did not want it. Now they suddenly do. I should have known that because I know their fund's getting to the end of the 10-year cycle and they need to return their funds. So once it gets towards that point, they're going to push hard for acquisition. To know that and work with them on it gets you a lot easier to raise funds the next time. I say if you're an entrepreneur and you're planning on playing multiple rounds, play the long game. Build a relationship, help them make money, and then they'll fund you again next time.
Amazing. I've spoken to a lot of CEOs this year who've been struggling with investment. It's been harder than it has been in previous years, and I know there's loads of things.
This has been I've been raising for over 20 years. I'd say it's been a long. 2008, there was a period in there where it was really really bumpy, but it was a fairly short period. But this is worse than that for me. This is this year, as both a VC and the other side, I've seen there are some real, even companies that are doing quite well have gotten down rounds, and that's pretty bad. That's a pretty bad year, but I'm hopeful for next. But go ahead, you were saying.
No, definitely, and I think it's reassuring in a way to know that it's they're not the only one. It's an industry problem, and perseverance and
me too.
Resilience.
Yeah, me too. I mean, and I'll tell most people, I am hopeful. I am an economist, but I'm not a qualified economist to make a forecast here. Look, there are indications that there's going to be a better exiting activity next year, which should free up some capital, lower interest rates, and a few other things, should ease the market next year. But I'll be honest, I did not forecast 2023 being a disaster, and I timed my company to do a large raise in 2023. And it was I couldn't have known, but it turned into one of the worst decisions I ever made. I was offered a large amount of money previously. I turned it down because I wanted a slightly higher valuation. When the market tanked, I got caught without a round.
Hmm.
And there's a famous VC, Fred Wilson, who says, think of fundraising like gasoline in the car. Just get it, convenient, move on and build your business. I think that's nice, but it's a little simplistic. That really, you have to be pretty famous or pretty well-off entrepreneur to be able to just access it when you sort of need it and want it. It doesn't really work that way. So you do have to pay attention. Sometimes you take more money because things are good. And sometimes you have to survive really on nothing for a while things are bad.
Yeah. Well, I hope you're right about 2024. Fingers crossed it's a better year for the industry and obviously for you as well.
Mm-hmm.
And I've no doubt the knowledge that you've imparted today will help a lot of people. So
I hope so.
thank you for sharing that with us today.
Great.
As a closing tradition, I ask how you think the battery will look in 10 years. Obviously, we talked about 2024,
Yeah.
but in 10 years, how do you think it will look?
Well, so my first thing is forecasting. I'm happy to do it, but the reality is I could roll dice. The 10 years, that's not an accurate thing. But instead, I'll do something called base case. So look back 10 years. How much progress have we made in the last 10 years? And if I just extend that line, that's as good a guess as any. I'm going to make an interesting observation. Things haven't advanced nearly as far as people thought in the battery world, my battery world, because batteries are much harder than people thought. So it's advancing slower. What is advancing is everything around the batteries, the ability, the infrastructure, the whole idea that people are accepting that EVs are possible, the migration to solar, that whole mental change has started to happen. Not everywhere. And especially there are sections of the US which are super anti-climate, and that's a problem. But there's a big chunk of the world that started to accept this as a problem. And honestly, that accelerates a lot. So I do expect a large amount of progress in everything from solar, wind, battery storage, all this sort of stuff. And I expect but I also expect EVs to struggle for a few more years as people deal with the whole range anxiety and broken chargers, as people sort of figure out how to build the infrastructure. Then I do expect a little bit more acceleration as there are more infrastructure for them. I think you'll see a lot more adoption. Right now, it's still only early adopters getting the cars. I think you'll see it's called sort of the middle. Excuse me. So as you know, that curve, the sort of early adopter curve, you have to transition to mass market. I think that's still a few years away. I mean, they're trying to force it, but I think the governments are going to have to give up on this idea of 2035 being only EVs. I don't see the infrastructure being able to meet that. But I do think we have an opportunity to migrate a lot to it. And there are many things to mitigate, but I don't think we're going to hit that aggressive. So 10 years from now, I do see there's going to be a lot more EVs, but I also think there might be hydrogen, there might be other alternatives, but I still think you're going to still see fossil fuels because there just are some problems that are really hard to solve. But I think we're going to be on a path there. I do expect there'll be a couple of different battery chemistries and a bunch of other things in your car, and I do think there'll be advances. I don't think it's going to be 100%. We're not doubling the range, but we might get 30 or 40%. And a lot of that we'll be doing with things like aerodynamics and weight and other changes that won't be the actual battery chemistry. Battery chemistry might improve 20 or 30%, maybe 40, 50, but I think all the other things around it will improve. Roads and tires and aerodynamics as we get better at this. So I do see big improvements, but I see it from 100 little changes. I don't think there's any one thing. Well, maybe there will be, but I don't see one thing making this drastically better. I see 1,000 ants building something, not one giant lifting a rock.
I think we should finish on that. Very good ending. But Rob, thank you so much for today. Really appreciate you coming on, and good luck for 2024. Hopefully it's a better year.
All right. Good luck. Thanks very much. All right.